Hey everybody, thanks so much for joining today's webinar. I know there's been a lot of action happening at Boeing, and with that, we've been getting quite a few questions on one, the pension versus a lump sum decision, and two, just the state and safety of the pension at Boeing with all the challenges the company has had. And so for today's webinar, we'll be really honing in into those two aspects and covering a lot of these different questions and queries in relation to that. My name is Dave Mantell with Stabler Wealth Management. I'm a certified financial planner and managing partner here at the firm, and I will be leading today's presentation on the Boeing navigation of your pension versus lump sum decision. Okay, so as I share my screen here, we will jump into it and cover all these main aspects that you need to be thinking about, whether you're part of the recent Boeing layoffs or if you're just nearing retirement and trying to position appropriately ahead of this big time decision you'll be making. So breaking today's presentation down, we're going to do it in a few different aspects. First off, we'll look at that lump sum and pension annuity decision and go over what that means and help determine what the right decision is for you. From there, we'll talk about, is your pension safe given the recent Boeing issues that we've been seeing? And then we'll round out the presentation going over the mechanics of starting your pension, especially in relation to the recent layoffs, when to start that, what that looks like, how to flip that on. So for those of you that haven't joined our webinars before, a little bit about us. At Stabler Wealth Management, we specialize in working with Boeing employees and retirees. We have a team of CFP, certified financial planners, so we're fiduciaries, and our focus is providing personalized advice to those that we work with to help drive better outcomes and really a successful transition and an enjoyable retirement from a financial perspective. You can find more about us at our website, planyourboeingretirement.com. And we also have a lot of past presentations that we've done, as well as other pertinent articles on the website. So make sure to log on and you can see other topics that might pique your interest as well. All right, so with that, we're going to jump into the big decision whether to take the pension or the lump sum from your Boeing retirement. And so, when explaining the two, the pension in reality is an annuity. And what that means is when you elect the pension for your Boeing retirement benefits, you're going to receive that monthly pension amount the rest of your life. And it's going to be the same amount you get now as you get in 20 years. But essentially, it's a lifetime stream of payments to supplement your retirement income. The lump sum, on the other hand, is Boeing saying we are not in the business of being an investment manager and paying out all these payments over time. So in recent years, they've offered the option to say instead of getting monthly payments for life, they're going to give you one big chunk, a lump sum check, and let you decide how to manage and be responsible for that money. So both options have their pluses and minuses. With the pension annuity program, the pros are you're getting lifetime payments, right? You're delegating the investment, the longevity risk to Boeing. You're going to continue to receive these payments on an ongoing basis, and you don't have to worry about the management of it. The downside of this is that one, these payments continue for your lifetime. You can elect a survivorship option, which determines if you pass away, how much your spouse receives. And if you choose the 100% survivor for your spouse, for example, you get a lesser amount while you're living to provide that continuity to your spouse. If on the flip side, you choose a single life, so there's no continuation to your spouse, you get a larger amount, but when you pass away, that pension stops. Once you and your spouse are gone, nothing continues on to your heirs, your children. There is a 10-year certain option, which is a bit more nuanced. But aside from that, once you pass away and your spouse passes away, That's it for the payments. There's no continued legacy to your family. Also, this is a big one, but the benefit amount, like I noted to kick things off, you're going to be receiving the same monthly payment in 20 years as you are when you first retire and start your pension. The benefit amount does not increase with inflation. As we've seen these recent years where we've seen inflation become a real-time aspect, that can really erode your buying power over time. I always use the analogy, a hamburger is going to cost a lot more in 20 years than it does today. And so your pension over time is going to become less and less powerful as it loses buying power. So that's a real-time consideration in this higher inflation world that you have to deal with. And also, there is some risks that we're going to get onto in the coming slides that you are relying on Boeing and the relevant insurance bodies to make those pension payment checks the rest of your lifetime. And if you're saying, well, I got good longevity, I might live another 30, 40 years, a lot can happen over that time frame. We will go over the protections here shortly, but still a fair question to be asking. On the lump sum piece, rather than getting those monthly payments for life, you are getting a big chunk of money right now. The positives of this is money today that you can control and invest and look to potentially invest for growth as well. And so having that control, the flexibility is definitely a very appealing aspect. On top of that, that money is yours. And so once you pass away, if your spouse passes, whatever remains of that lump sum amount will continue on to your family or to the causes that you elect. And so it doesn't stop at you and your spouse. So there's definitely a legacy component there. In some situations, if you have poor health, if you have a special needs child, if there's an importance of keeping that legacy, sometimes it can make the lump sum a really appealing option. But those are some facets that are positives on the lump sum end. In terms of negatives for the lump sum is you are shouldering the investment risk. As we go through ups and downs in the markets, it's important to make good, wise investment decisions with that money. But it's on you to make sure it reaches your goals and serves you appropriately. Boeing isn't shouldering that risk for you. So that's kind of a breakdown of a pension annuity versus a lump sum option and some positives and negatives of each. Okay. So as we compare the two options, a lot of times we get the question on, okay, so which one's better? And first off, it's good to run the math because sometimes this will get you pointed in the right direction if you're torn or not leaning one way or the other, for example. And so we like to look at it and say, okay, if I take the annual pension benefit, so the monthly payments for life, how much am I getting each year? So the monthly benefit times 12 months, right? And what is that as a percent of a lump sum balance? And what this tells you is, let's just say you get 7% each year of a lump sum balance. If you take the lump sum and you earn 7% every year on that money, then you would have your lump sum balance and you'd be making what the annuity would be if you chose that route, right? So if you knew you would make that percentage every year, you would take the lump sum because you have the lump sum plus your earnings are equal to the pension. If you earn less than that percentage, the pension's going to be a higher amount and over time start to cut into that lump sum balance. And so when running the math as a starting point, there's kind of three tiers that we'll look at. If you add up your pension benefit that you receive each year, and it's over 8% of a lump sum amount, that tends to be pretty good bang for your buck on the pension. And if you're just totally neutral and undecided on each, it's very situational, of course, but that could, mathematically at least, pretty good deal. You couldn't take that lump sum amount and go buy an annuity with an insurance company and get the same pension payoff, for example. And so again, doing that math, what's my monthly pension benefit? Uh, that times 12 months of a year, divide it by the lump sum amount. If the pension benefit's over 8% each year, pretty good starting point. If you run the math and you say, okay, it's 6 to 8%, it's a bit more neutral. We're kind of in a territory where you could take the lump sum and buy an annuity at an insurance company and likely get a similar, sort of return on that. You could do that with some of the lump sum money. You could invest some, or you could just try to invest it and get a return commensurate. But that 6 to 8% tends to be a bit more neutral. Let's call it a wash. And if you add up the benefit and your annual pension benefit is less than 6% of the lump sum amount, mathematically, the lump sum's looking pretty attractive in terms of kind of what you can earn on that and how the comparison is. And so one of the key aspects of a lump sum calculation is the segment rates, which is basically, a benchmark for where interest rates are in general. And so when after COVID, when interest rates went way, way down and the segment rates followed, basically it resulted in a huge increase in lump sum calculations. And so in a lot of cases, someone may say, I have a $4,000 a month, $50,000 approximate year in annuity, or I could get $1 million lump sum. And so that was in this math where it was like, gosh, that lump sum is very attractive mathematically, where you'd have to have a very specific reason to, take the annuity instead. And so this is always a good starting point when we sit down with folks is kind of doing the math. What's your monthly pension benefit going to be? How's that compared to the lump sum amount? And we could start and just see what category it's in. So that may kind of push us one way more or the other. If you have a union benefit versus non-union, the math's different. So for example, specifically for SPIA, those BSERP, pensions, the lump sum tends to be relatively more attractive than a PVP commonly. And so that's also a determination. Everyone's pension is different. So you want to run the math for yourself and look at how that fits into your own situation. Okay. By the way, the good news is this is what we do every single week for folks. And so you do not need to go it alone. I'll provide some information at the end in terms of how you could connect with us. But yeah, we'd love to kind of run the math, run the numbers with you and help you make that determination. So if I've already lost you or, this isn't your forte, in terms of kind of doing finance math, again, feel free to run the numbers with us. You're not on your own on this at all. Okay. Um, as we look at those different tiers, that brings us to what does this mean? So this is an illustration where let's just say you had a $4,000 a month pension benefit if you took the monthly pension. So that's just under $50,000 a year. And let's just say your lump sum benefit, if you went the lump sum route, was $715,000. The way this math shows is sort of how long it would take to receive those monthly benefits at different return levels to catch up to the lump sum chunk of money you're getting today. So that green on the far left side, this is if you took the lump sum, you put it under your mattress, you didn't earn $1 of earnings or growth on it. If you took that $4,000 a month pension benefit and kept collecting that for 14 years, after year 14, you would have received approximately 715,000 in total. So that's kind of a break-even age, right? So in this case, if someone's 60 years old, by 74 or so, you would have received about the equation of that lump sum amount in monthly payments if you didn't earn anything. Okay, so that's kind of a starting break even. Does that kind of make sense? Yeah. The brown line in the middle says, well, I could do a little better than putting that lump sum under my mattress. So I'm going to take my $715,000 lump sum. I'm going to put it in a really conservative bond investment. And let's just say I earn 4% a year for the rest of my life on it. On that 715,000, 4% a year is about 30,000 a year or so. It isn't 50,000 a year that you receive on the pension, but it's a portion of it, right? So in this case, if you compare the lump sum earning 4% a year to the pension, you got the 715,000 lump sum. If you make 4% a year, that's about 30,000 a year you're making. The pension at 50,000 a year is only 20,000 more a year, right? So that excess 20,000 you receive on the pension payments, that would take over 30 years of that amount to catch up to the lump sum earning 4% a year. So in this case, a break even might be age 90 or so, right? If you're 60 at that 4% a year earnings. So now we're kind of saying, oh, this is a bit of a wash, right? Um, Let's just say you earn 6% a year. And by the way, this kind of more aligns with when we work with folks retiring, what we like to use for retirement projections over time. We like to use 5 to 6%, which historically has been a very achievable benchmark. We don't want to be over enthusiastic, but at the same time, we want to be realist on this, right? And so let's just say you took your 715,000 lump sum. This is a red line and you made 6% a year on that. So now we're talking, close to 45,000 a year. That is pretty close to the 50,000 or so a year you're making on the annuity payments. And so, yeah, the annuity, you're maybe getting another 5,000 a year or so, right? On top of if you a 6% return on the lump sum. But that is a lot of years for that 5,000 excess to cut into a 715,000 lump sum balance. So as you can see, it'd be, well into your 100s, right? Before that caught up in that case. And so if you knew you're going to make 6% a year on a lump sum, even 4 or 5% for that matter, you'd almost likely take the lump sum, right? If you had that surety. So, and then, by the way, if you make 7% a year on the lump sum, you'd be earning on the lump sum what the annuity payment would be. Plus, you still have your lump sum balance. So, again, no brainer, you take the lump sum there. And so, this kind of help explains the math as we compare that to those different legs. And so, as we look at for your pension numbers, where that break even lands, we could help guide based on a return assumption on what the right decision is for you plus all the other factors on other income that you have, your family situation, any family you need to support, those all weigh in as well. Okay. Uh, Hopefully I didn't lose anybody on this chart, but this is kind of a good way to show the break evens a bit and at different return assumptions, how the money projects over time with that decision. Okay. So now that you've kind of ran the math and decided what's the best decision for me, what fits into my lifestyle, my situation plan based on my pension calculation, that kind of brings up if you are leaning towards taking the pension, how do you get comfort that your pension's going to be there and that it's safe, especially given all the news headlines surrounding Boeing, right? And so, we've been getting this question a lot, and to be totally candid, we haven't had much worry. It hasn't really crossed our mind much in terms of being a risk until more recently. This past year, right, we've seen Boeing just losing billions of dollars, every year, and we're on many years of this. Yes, we're very hopeful at some point Boeing will turn things around and, get back into the profit column. But in the meantime, as we've seen the stock price erode, we've seen the losses mount. It's a worry, right? It's not a guarantee. I don't think any of us would bet our retirement that Boeing is going to stay solvent, for the rest of our lifetime. And so that kind of brings us, if we do have even a shadow of a doubt that Boeing going to be able to make these payments themselves, how do we get confidence that our pension is going to be safe? Whether you're making the decision to take the pension now, or if you're already retired and receiving the pension. And so this research analysis has been really positive for us in giving us some renewed confidence in that regard. And so first things first, Boeing has a fully funded pension plan. And what that means is across all the various pensions at Boeing, Boeing has, close to 50 billion of pension liabilities, so pension payments they need to make to retirees both now and in the future. And their plan is fully funded, where they essentially have just over 100% coverage for assets in that pension plan. And so, right off the bat, that is good news that as of now, I'm assuming those funds are managed the right way. They are fully funded. That plan is fully intact. With that being said, there's risks there. Things can change. This is based off current mortality factors. Recent expectations are as we fast forward, a couple dozen years, there's going to be 3 times as many 85 plus year olds as there are today, right? People keep living longer. And so that's a risk to Boeing as longevity increases, that the liabilities are going to increase. There's more years Boeing has to pay pensions. In addition, that pension fund can move around a bit. 2022 was a down market year. Going into 2022, the pension was about 120% funded. Into 23, that number was down to just over 100%. That's a very big swing. And so it shows if you go from 100 to 80%, what if we deal with some tough finance years? So that's a risk. But anyways, the first line of defense is that fully funded pension plan. The next aspect is Boeing has to make good on its pensions, right? This is a commitment that it's made. And so Boeing basically has to go bankrupt before it will continue to pump money into the pension plan. So let's say Boeing's still operating, the pension plan, for whatever reason, is no longer fully funded and there's a risk there. Boeing has a commitment to continue to contribute funds into that pension plan to keep it fully funded and cover those liabilities. Okay. And so that Boeing backstop is the next level of guarantee. Let's just say, for whatever reason, the pension plan went bankrupt. On top of that, Boeing had solvency issues and went bankrupt itself and was not able to make those payments. That is when the PBGC, Pension Benefit Guaranty Corporation, which is sort of a quasi-government insurance body, that's where that kicks in and then starts providing support on the pension payments. The saving grace here is Boeing is part of the single employer pension program, which is night and day difference from the PBGC multi-employer, where you have multiple companies kind of banded together. One, the single employer PBGC program is much better funded. Many, many billions times that of the multi-employer plan. And on top of that, it provides very good coverage in terms of the pension payment amounts it will cover if leg one and leg two failed. And so, with that in mind, the PBGC, single employer plan, provides great coverage. That insurance body is really well funded. Historically, it hasn't had issues, right, in terms of covering payments. And so that is a safety net over the other two. When we look at what those guaranteed payments look like, if we do get to that third leg and the insurance body has to kick in, what they do is they look at your age when the pension fails and the PBGC has to step in for coverage. And so, for example, if you are 65 and let's say you are on the single life pension plan, the PBGC will guarantee up to $7,108 monthly payment. So for just about everyone I've seen at Boeing, that would be full coverage in that situation. If you're age 55 when that happens, the coverage is $3,199 for single life, $2,879 for a 50% survivor. So that's a scenario where you may not fully receive your pension, right? You may have it chopped down or discounted to this covered amount. Still better than nothing, right? That still provides a good level of support. Again, a lot has to happen before we're in this world where the insurance body kicks in. But nonetheless, it's good to see that there's good coverage. It may not be full coverage for anybody, but it is a nice kind of safety net in that regard. So in conclusion, based on our analysis, There's a very high probability your Boeing pension will be safe. Very, very high probability the entire amount will be. In the event the insurance body kicks in, it'll be based on the age when that happens, right? But likely you'll still get full, if not near full coverage. So that's the good news. Um, Again, the single employer plan of a PBGC is a big deal. So that's kind of a key component versus a multi-employer, which is a lot more flimsy. So that's good news. And by the way, as Boeing is set up as a single employer plan, there's not a precedent where they could get bumped to multi-employer, for example, right? That would kind of take away from the whole aspect of a protection of being on that single employer plan. So that's good to see. But with that in mind, this is still a consideration, right? Especially given the health of Boeing. And, there's a couple of risks here. One of the risks is the laws can always change, right? And so even though this is the way it works today, things can change in the future. We could go through a big crisis where the PBGC is no longer fully funded. The government isn't required to kind of make full commitments or payments there. And so, while we feel very solid about it, and I would not lose a wink of sleep about it, if you are newly retiring and you're literally just torn right down the middle in terms of do I do the lump sum or pension, this might be that, 1% nudge, right? That helps you decide. Saying the fact that we're even doing this exercise might say, I just want to receive a lump sum, have control of the money, and kind of, sever myself from Boeing. So that's a consideration there. Okay. But overall, we feel a lot better after doing the exercise, so you should too. Okay, so with that in mind, you've determined if the lump sum or the annuity is best for you. You got around your head comfortable with the solvency of the pension annuity payments, or if you didn't, or if you're still not there based on the last slides, maybe that drove you to the lump sum decision. Next is logistically, when do I start my pension? Especially if the recent layoffs had happened, what's the best way to go about that? Um, and so if you are part of a layoff and you are a union employee, the lump sum you can take right away. Um, and so, you know, if you do a lump sum, you separate from Boeing and you could commence on the first after. So you could take it right away. If you are union and you take the pension payments, the annuity payments, you have to wait until your severance pays out. And so if you've been at Boeing for a long time and you get that max 6 months of severance, you have to wait those 6 months. You're not going to receive pension payments those 6 months. And then after the 6 months of severance payments, you could start your annuity. Um, if you take the lump sum in your union, it disqualifies you from a recall. If you want to retire anyways, this could be a good thing, right? If you don't want to get recalled and have missed part of your pensions, 3 months in, but just something to keep note of. For non-union employees, part of a layoff, you can take your pension and severance at the same time. Taking your pension does not impact your severance. In most cases, if you're taking the annuity pension payments, this is generally a slam dunk, especially if you're under the age of 65. But essentially, you want to make sure, yeah, you could say, well, if I have my pension and my severance, my taxes are going to be high. Is this going to put me in a higher tax bracket? Yada yada. But I think on the flip side of that is even if it does, that's marginal. You don't want to miss 6 months of pension payments you could otherwise be receiving. Um, again, something to look into, like if you're over age 65, you wait to commence. Generally speaking, you can make up for those missed payments and receive those once you start. But in general, if you're taking the pension or the lump sum for that matter, in most cases, it's a slam dunk to start right away. By the way, I've seen emails from HR confirming this. It's been, helpful kind of working with folks. But I've heard from other people saying they're getting mixed messages. I would contact the retirement coordinator, confirm all these points specifically, so there's no if, buts, or about it, but go through this is my situation. I'm doing the lump sum or pension. Here's how I start. just because these are such big decisions, right? We want to, make sure you get it absolutely right, confirm, get email support from Boeing. But this is kind of what we've been seeing and verified from folks we've worked with. Okay, so with that in mind, there's a number of steps to take here, right? Item one, being part of the layoffs or in general retiring from Boeing, decide if a lump sum or the pension annuity is right for you. Okay. Number two, whether you're non-union or union and you're taking the lump sum, typically you should start that right away and commence it as early as possible. That way you get that money in your control and you could start investing it. And so if you're part of the layoffs, your separation is formally in January. The earliest you could commence is the first of the following month. So that'd be February 1st in most cases. From there, you're going to want to evaluate whether to take the retirement medical, um, early retirement medical if you qualify. So that's if you're last hired before 2007. Or you could look at whether the 3-month layoff COBRA is better to start taking initially and then switch to retiree medical. This is very situationally based on your start date at Boeing, your specific situation. And in some cases, it could be less expensive or cheaper to you to start the retiree medical right away rather than staying on that 3-month subsidized health insurance, right, with Cobra. And so, again, this is where I would meet with the retirement benefit coordinator. I know they're slammed right now, but I just confirm your medical insurance coverage and do the math really quickly with them to see what puts more money in your pocket. Okay. And then with that, there's a lot of other decisions in line. If you have multiple pensions, we commonly see where you may have a B-cert pension and a PVP. You can make different decisions for each. You could do the lump sum on the B-cert, which tends to provide more bang for your buck, and the annuity on the PVP, the pension annuity. You could do the annuity for both, the lump sum for both. But definitely based on your situation, run the numbers. Again, this is what we help folks do and see what the best decision is for you. And then also, if you do take the pension, make sure to choose the right survivorship decision for your spouse, because that's a big deal in terms of not only making sure that you have the income coverage you need, but if something happens to you, you have the right level selected for your spouse for your situation. And again, you could decide to take the single life annuity, the 50% survivor, 75 or 100%. Generally, the 50% is very good bang for your buck. It reduces your pension by 5%, but that provides a 50% for your survivor. So you probably at minimum want to do that. The 75 and 100% are very common, right? Where you're looking to have that continuity to your spouse. But again, this is a situation for you, so it's good to run the numbers and see where you land. So with all these decisions you need to make, this is a time to do a trial run of your retirement plan, go through the motions, see what retirement income looks like, what's your tax situation, how are your accounts invested to support that. And so this is where you really want to work with your CFP, your certified financial planner. You want to work with a fiduciary to kind of set up that correct retirement success journey for you. As you've seen, if you've attended one of our past webinars, and I always appreciate talking to folks. We've been really busy recently doing these, but we've been talking to dozens of folks to kind of help with these decisions. And so we provide a free second opinion on your retirement plan. So we're offering a free 1-hour complimentary review to look at all these decisions for you and review your retirement picture. It's as simple as going to our website, planyourboeingretirement.com. There's a big orange button at the top where you could click Let's Talk, and that will allow you to set up an initial conversation with me from our firm. So you could set up a phone call or a virtual meeting, and we'll just talk through situation, go over those key decisions you're looking to make, what information we need that's helpful, and then that will allow us to do that, complimentary 1-hour consultation to help with those decisions. There's no obligation to do this. Of course, retirement is such a big decision where, you're going from the the complexities of taking out money, how to manage taxes, how to manage retirement income, versus when you're putting money in your working years. And so kind of a lot of times it tends to be a great catalyst to start working with a fiduciary financial planner to help with those kind of high stake complex decisions. But that's okay. We talk to a lot of folks that, really kind of like to do it themselves and have passion about, these aspects. And these are still really great meetings where we're able to provide our 2 cents, provide some feedback. And so no matter which camp you end up in, yeah, we really recommend you taking us up on our offer. These are great meetings. We really enjoy them, and we'll see how we can help you with these really big, decisions. These are some of the biggest decisions from a financial perspective that you're going to make in your life, right? So we want to make sure we help you get them right the first time. So yeah, I look forward to hearing from a lot of you. We are going to keep these topics coming, with the webinars, articles. I know there's a lot happening at Boeing. And as we come up with topics like this, these are based off feedback that we receive from you. And so please reach out to us to let us know other topics that you would find helpful, because other people surely would also be interested. And also pass this information, extend these invitations to your colleagues. They could go to our website, you could send us an email, but we'd love to hear from more of you and see where we can help out as well. And so good luck on your journey with Boeing. We are happy to be here for a resource. You do not have to go it alone, and do not hesitate to contact us with any questions. And enjoy your holiday season and have a great new year ahead. Thank you so much for joining.